Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Qfin Holdings Inc. latest report. Qfin Holdings Inc. operates an AI-driven credit tech platform that provides various services to its clients. The company offers credit-driven services that connect borrowers with financial institutions for borrower acquisition, credit assessment, fund matching, and post-facilitation services. In addition to these services, Qfin Holdings also provides platform services to its financial institution partners. These services include loan facilitation and post-facilitation services under an intelligence credit engine, referral services, and other technology solutions. The company's clients consist of three main groups: financial institutions, consumers, and small and micro enterprises. By providing these services, Qfin Holdings aims to facilitate the borrowing process for its clients, while also supporting the growth of financial institutions in China. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On the positive side, financing income has seen a significant increase of 32% year-over-year, YoY, due to the growth in average outstanding balance of on-balance sheet loans. Additionally, revenue from releasing guarantee liabilities has also grown by 20% YoY, driven by an increase in the average outstanding balance of off-balance sheet capital-heavy loans. However, there are several drivers that have contributed to revenue decline. Loan facilitation and servicing fees under the capital-heavy model have seen a substantial decrease of 45% YoY and 61% quarter-over-quarter, QoQ, primarily due to a reduction in capital-heavy loan facilitation volume. Referral services fees have also plummeted by 89% YoY and 85% QoQ, largely attributed to a decline in loan facilitation volume through ICE. Furthermore, net revenue from platform services has declined by 58% YoY and 51% QoQ, resulting from decreases in various platform services fees. The net income of the company experienced a significant decline in Q4 2025, decreasing by 29% compared to the previous quarter. This trend continued year-over-year, with a staggering 46.8% drop in net income from RM 912.7 million to RM 16.1 million. The decrease in net income was accompanied by a decline in profit margins. The net income margin decreased from 27.5% to 24.8% in Q4 2025 and from 42.7% to 31% year-over-year. Although the non-GAAP net income margin remained relatively stable, decreasing only slightly from 26.5% to 26.2%, it still indicates a decline in profitability. The reasons behind this decrease are attributed to macroeconomic uncertainties and regulatory changes that led to an industry-wide liquidity squeeze and elevated risk levels. Additionally, the company experienced a decrease in income from operations and an increase in provision for contingent liability, further contributing to the decline in net income and profit margins. The company's financial performance indicates a healthy trend in its ability to generate cash from its core operations. A key indicator of this is the positive operating cash flow, which has been consistently achieved over the past 2 years. In 2024, the company generated $9,343,311 in operating cash flows, and this figure increased to $11,083,748 in 2025. This upward trend suggests that the company's operations are becoming more efficient and profitable, allowing it to generate a significant amount of cash from its core activities. The company's debt level has experienced a significant increase over the past period. According to financial reports, the total debt level rose from RMB 23,886,399 to RMB 32,792,752, representing a substantial 37.4% growth. Furthermore, net cash used in financing activities also saw an increase from 1,873,516 RMB to 4,212,147 RMB. In terms of interest expenses, the company has reported a notable change as well. Financing income has increased significantly, rising from RMB 1,667.3 million in 2024 and RMB 2,340.6 million in the prior quarter to RMB 2,206.3 million. This substantial growth in financing income suggests that the company's interest expenses have likely decreased as a result of improved financial management and reduced borrowing costs. The company's performance can be analyzed through its various segments and regions. On the positive side, international operations have been a strong performer, contributing to the company's overall success. Additionally, the company has achieved a record-setting RMB 11.1 billion in cash from operations in 2025, indicating a healthy financial position. However, there are areas that require improvement. Domestic businesses have struggled, failing to meet expectations. Furthermore, the prior quarter's net income was also disappointing, suggesting a need for corrective measures to get back on track. These underperforming segments will likely be a focus area for the company in the coming period. Management is expressing a cautious outlook due to the current macro uncertainties and regulatory changes affecting the company. However, they remain optimistic about their ability to adapt and thrive in these conditions. To mitigate these challenges, management plans to diversify the business geographically by expanding into international markets. This strategic move aims to unlock long-term growth opportunities and ensure the company's continued success. The company's strong financial position is seen as a key enabler of this strategy, allowing them to navigate challenging environments and achieve their strategic goals. The company's financial strategy has been multifaceted, with a focus on rewarding shareholders through various means. One key aspect of this approach is the payment of dividends to investors. This move not only demonstrates the company's commitment to its stakeholders, but also provides a tangible return on investment. In addition to dividend payments, the company has also engaged in share buybacks. By purchasing back shares from the market, the company can reduce its outstanding share count and potentially boost earnings per share for existing shareholders. This strategic decision reflects the company's confidence in its financial position and its desire to create value for investors. That concludes the financial summary for Qfin Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.